The stock of Tilray Brands Inc., trading under the ticker TLRY, is currently sitting at $7.32 per share, showing an intraday movement of minus 0.43% as the market navigates the mid-morning session. Now, the common expectation for a cannabis stock, especially one that just executed a reverse stock split, is that it's simply a struggling company trying to maintain NASDAQ compliance and that the slight dip today is just more of the same pain. The reality, however, is far more complex and involves a strategic, albeit aggressive, shift in the company's business model that the market is still trying to properly price in, and the initial negative reaction to the 1-for-10 reverse split in early December may actually be masking some underlying strength in their non-cannabis segments. That's the tension we need to focus on. The market sees a desperate cannabis player, but management is positioning it as a diversified global consumer packaged goods company, and the next few months will determine who is correct. Investors, particularly those who have been holding shares for the past few years, are acutely aware of the dramatic volatility and consistent downward trend that led to the necessity of the reverse split. The expectation is that Tilray remains entirely dependent on regulatory changes in the U.S., and that until federal action occurs, the stock will remain a speculative trading vehicle rather than a core investment. This common belief entirely overlooks the significant shift in revenue composition that Tilray has pursued over the last couple of years, primarily through its expansion into craft beer, spirits, and wellness products. While the legacy cannabis division is what draws the headlines, the beverage business, boosted by acquisitions like the one announced last year, provides a substantial, non-cyclical revenue stream that acts as an often undervalued ballast for the stock. The market narrative focuses on the red ink from their marijuana operations, but the reality is that the diversified CPG strategy is what keeps the lights on and provides a credible path toward eventual profitability that is not solely contingent on political progress. The latest news releases show the company focusing on holiday drink gift guides and expanding medical cannabis operations into places like Panama, which are subtle indicators that they are pressing hard on both fronts of this dual strategy. Let's look at the recent price action and volume. The stock has been highly sensitive to any news, good or bad, with daily swings being substantial. Just prior to the reverse split implementation on December 1st, we saw a noticeable spike in volume as retail investors speculated on the price point reset and institutional funds adjusted their models to the new, lower share count. This surge was quickly followed by a pullback, which is typical post-split behavior, as the initial speculative froth settles and the underlying fundamentals are re-examined against a higher nominal price. Today's minor slide is likely residual profit-taking from that pre-split run-up, coupled with the general sector malaise that plagues most Canadian licensed producers. Trading volume is currently higher than the average, suggesting continued, though largely indecisive, activity as buyers and sellers jostle over the perceived fair value post-split. Institutional ownership data shows a high turnover, with many funds filing 13F forms that detail significant churn in their positions, some increasing their holdings slightly while others dramatically reduced theirs, highlighting the deep division on what to make of this stock right now. This is not a stable accumulation pattern. It's a high-stakes poker game between long-term holders betting on federal legalization and quant funds trading the massive volatility. A non-negotiable part of the Tilray story is the short-selling pressure that has plagued the stock for years. Retail investors on forums like Reddit and X are constantly discussing short interest in TLRY, often calling for a coordinated effort. The latest reported short interest figures confirm that Tilray is absolutely under pressure. The most recent NASDAQ settlement date data, for example, shows a substantial number of shares sold short, which translates to a relatively high percentage of the public float. The days to cover metric, while often fluctuating, indicates that it would take a meaningful number of trading days for the short sellers to cover their positions based on the average daily volume. This is the actionable insight for retail. Watch that days to cover metric closely. If it suddenly spikes alongside a volume drop, it indicates vulnerability for the shorts. The cost to borrow shares is also a critical data point, though it remains relatively low compared to hyper-volatile meme stocks, suggesting that while the conviction from short sellers is present, the cost of maintaining the short is not yet prohibitive enough to force a mass exit. Large firms like Citadel Advisors have reported holding significant positions in Tilray's options, including a mix of calls and puts, which indicates complex hedging strategies, not simply a one-sided bearish bet. The short thesis is straightforward. The company continues to burn cash, regulatory progress is too slow, and dilution is a constant threat even after the reverse split. The retail counterpoint is the dream of full U.S. legalization. To react responsibly, investors need to monitor the FINRA off-exchange short volume ratio. Recently, a high percentage of the trading volume has been short-selling activity that occurs away from the main exchanges. A sustained drop in this percentage could signal a weakening of the short attack, but chasing a short squeeze based purely on social media calls is incredibly risky and not a sound investment strategy. The company's core business model is centered on a global footprint across 4 main verticals: cannabis, which includes medical and adult use products across Canada and Europe, the aforementioned beer and beverage alcohol segment, a wellness segment focused on hemp and CBD products, and a distribution business. While they hold the #1 market share position in Canadian recreational cannabis, the Canadian market is oversaturated, leading to margin pressure. So the growth narrative has shifted to the European medical market, where they are strategically expanding through cultivation and distribution licenses, and the craft beer and spirit brands they acquired. The latter provides immediate scale and cash flow diversification. For instance, Q1 fiscal 2026 earnings showed that while the medical cannabis segment saw decent growth, the overall profitability picture remains murky. Their focus on reducing cost of goods sold and streamlining operations is crucial, as they have consistently recorded net losses. Historical reports show a pattern of aggressive acquisitions and expansion funded through equity raises, which is what led to the high share count pre-split and the corresponding stock price suppression. The classic growth-at-any-cost model that has now been forced into a more capital-efficient posture. Looking ahead, the future outlook for Tilray is a pure expectation versus reality play driven by legislative momentum. The expectation is that U.S. federal rescheduling or full legalization will instantly send the stock soaring. The reality is that the regulatory process is a slow grind. The single biggest catalyst on the horizon is the potential reclassification of cannabis under the Controlled Substances Act, which is being discussed, or more broadly, legislative movement on the Safe Banking Act, which would provide access to standard financial services for U.S. cannabis businesses. While Tilray is a Canadian firm, any positive change to the U.S. landscape would undoubtedly elevate the entire sector. A possible scenario is that their diversified beverage alcohol division continues to grow, providing consistent cash flow that allows the company to reach profitability before any major U.S. federal action. If they can achieve sustained positive EBITDA from their non-cannabis businesses, the reality of the company will dramatically exceed the current market expectation. Conversely, the risk is continued dilution to fund ongoing losses, especially if a political catalyst fails to materialize. The stock is currently being held hostage between the slow-moving reality of political process and the hyper-aggressive speculation on that political outcome. The company needs to show concrete recurring profitability in the beverage and medical segments in the next 2 fiscal quarters to break free from the purely speculative trading range. What we want to know is what your take on this situation is. Comment below how many shares of Tilray brands you currently hold and what percentage of your portfolio it represents. Are you holding for federal legalization or are you trading the volatility? What's your take on the rising short interest, smart money, or manipulation? Ultimately, the core insight here is that while the market is focused on the reverse split as a sign of weakness and the stock is battered by short sellers playing the regulatory uncertainty, the management team has quietly created a significant, non-cannabis-dependent foundation. The question is whether the steady growth in their craft beer and European medical cannabis businesses can sustain the company long enough to realize the long-term U.S. dream, or if the sheer drag of high operating costs and sector-wide regulatory frustration will force further financial maneuvers. The upcoming earnings report, where we will get a clear post-split picture of their capital structure and cash burn, is the moment of truth for the company's dual strategy. The volatility will continue, but the direction will be determined by execution on the ground, not just headlines from Washington. We are watching for sustained revenue growth in the beverage segment and any further institutional accumulation to confirm if the smart money is beginning to side with the underlying business reality over the prevailing negative expectation.